Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on the clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, July 20th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in the areas that we feel offer the best prospects for growth, as opposed to trying to time the market. We'll focus exclusively on the traditional investments of stocks, bonds, and cash. So we analyze fluctuations in the stock market as well as interest rates to help drive our overall investment decision process. So we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. And for the 2-week period ending July 17th, the stock market was down slightly, at negative 0.34%. We have resumed the war with Iran, and all things considered, the fact that we are only down 0.34% for the 2-week period is astonishing to us. But yeah, I mean, it's amazing to us what can happen in a 2-week period. And yes, we're seeing a bit of a roller coaster in the stock market, but again, all things considered, not as bad as it could have been, or we would have perhaps expected with a resumption of the hostilities. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe interest rates really are the preeminent measure of investment risk. Rates are factored into every investment valuation calculation, including stock valuations. So generally speaking, declining interest rates may lead to lower costs of doing business and thus higher earnings, which should help drive stock prices higher. Increasing interest rates may lead to higher costs of doing business and thus lower earnings, which may lead to lower stock prices. So typically, in general, we say lower interest rates should lead to higher stock prices. Higher interest rates will lead to lower stock prices. We can also look at high yield corporate bond spreads to give us a glimpse into the probability of default for companies that are financing their operations. All right, very small changes to these interest rates over the last 2 weeks. We've got interest rates listed over here on the left-hand side and maturity lengths listed on the bottom. So each dot on these graphs is an interest rate for a particular maturity length. The green line is where we ended the 2-week period. The brown line is where we were 2 weeks ago. So you can see that most of these are up slightly over the past 2 weeks. So again, that also tracks with lower stock prices in general. If we look at just the U.S. 10-year Treasury, this is most closely linked to mortgage rates as well. We're drifting back closer to 4.5% on the 10-year Treasury, which is much higher than where we were as we had a ceasefire agreement in place at the end of June, and we were hopefully heading on a downward trend with interest rates and lower mortgage rates so that we could see some more activity in the real estate sector than we have. Corporate bond spreads still back to pre-war levels. We're really not seeing anything that gives us cause for concern. However, things can change pretty quickly with interest rate spreads. So, you know, we're grateful that there does not appear to be anything concerning at the moment, but you know that can always change in a moment's notice. We've shown this before, and I think we're going to make this a little bit more of a feature for the time being. So the Federal Reserve will set a short-term interest rate that they are trying to use for price stability to try and keep the inflation rate from getting out of control. The white line on this chart shows what the Federal Reserve rate has been over the last 25 years. We've also seen a high correlation with the interest rate on a 2-year U.S. Treasury bond, which is the blue line over the past 25 years. And then these red bars are recessionary periods that we've seen. So again, we've talked about this for the past couple videos. Suffice it to say, we're still in the same place that we were a month ago, 4.17%. Again, generally speaking, the Federal Reserve will raise their interest rate to try and push those rates down, try to keep and thus keep inflation going in a downward trajectory as well. It can be a little bit difficult to see every little tick mark here on the chart. So if I pull up a table of pricing, we can see that on July 17th, the 2-year Treasury was at a 4.1767, which is exactly where it was a month ago, June 18th and 19th. So we can endure fluctuations from week to week, and this has clearly been in an uptrend ever since the war started with Iran, but it may have plateaued. It may have peaked here around 4.17, similar to how it peaked here in the end of 24 and beginning of 2025. And so what we're anticipating, the Federal Reserve is not going to cut interest rates at its next meeting on July 29th. We don't think it's going to raise interest rates. We think they're going to continue to hold it steady, hoping that the 2-year rate will come back below the Fed funds rate in the near future. We're not as optimistic about that at the moment, considering the resumption of the Iran war, but that is a possibility. So most economists that we're listening to suggest that the Fed will increase from a 3.75 up to 4. Some even suggesting that they'll go up to 4.25 just to, in one fell swoop, try to get back above the 2-year and try to push it down. So we'll see how that goes. But for our expectation, at least for now, is that we'll see no cuts, but they're going to try to maintain the current rate level and let the market do its job. Oil prices, I'm not sure where the heading went on that. There we go. Oil prices has started creeping back up. Of course, here we were 2 weeks ago, naively thinking that everything was fine and the war was over and we were going to work out a peace deal that was going to be upheld. And 2 weeks later, we're basically back to full-blown war with Iran. So oil prices going back in the wrong direction. Gas prices back close to $4 a gallon. So yeah, things have changed a lot in the last 2 weeks. So there is a lot of doom and gloom out there. We're trying to be not always permanently optimistic. We're trying to be realistic about what we're seeing out there, and trying to do the best we can to figure out where the opportunities are and where we might have been excited about a certain strategy 2 weeks ago, maybe calling it into question if that's a narrative that's going to be upheld, or if we need to rethink a few things over the next couple months. All right, some of the other highlights from the past 2 weeks. So obviously the ceasefire ended, oil and gas are up, stocks are on a roller coaster. And we just got a headline as we're recording this that 2 service members were killed in action in Jordan. So we anticipate that there will be a response to those individuals passing away. That doesn't make us super optimistic that this is coming to an end anytime soon. And the longer this drags on and the longer that the Strait of Hormuz is closed and oil and other products don't get through the Gulf, then it causes more issues for inflation and it causes more issues for our economy. Having said that, the economic data that we're seeing come out for the month of June is really good. Obviously, we had some declines in oil and gas prices, which helped move the needle in the right direction. That is changing, so we'll see what the July numbers look like when they come out in a few weeks. But second quarter earnings season has started. Just some observations that we've had, not investment advice, not a recommendation, but we did notice that IBM had essentially their worst day ever in the market after reporting their earnings, and they're actually consequently being investigated for securities fraud based on how bad their earnings report was and how bad the stock performed in that one day. We also observed that SpaceX, that had their IPO about a month or so ago, is now trading lower than the IPO price. So that's interesting as well. We're also hearing other people speculate that that SpaceX will trade lower as more of the individuals who work there and are owners of the stock are able to trade their positions. But again, a good economic data coming out suggests that the economy is fine, right? Despite all the war, despite all the tariffs, like everything that President Trump has been throwing at us for the past 2 years, year and a half, 2 years, the economy is still chugging along. We did have President Trump come out on Thursday in a national address and essentially accuse China of election fraud, specifically regarding the 2020 election, stealing voter information, et cetera. And so I guess it should have been no surprise to us that Friday morning, within hours of this allegation, a Chinese artificial intelligence company announced an update to a model that they had that is supposed to be able to compete with the best that we have here in the United States. So obviously we've shown before there's a lot of inflated stock prices this year in artificial intelligence names. And so a lot of the volatility that we see in the market from day to day and week to week depend on what we think is happening with artificial intelligence and the adoption and so we're a little bit pessimistic right now about that sector, right? Semiconductors, artificial intelligence as a sector, as an industry, is struggling a little bit. The majority of stocks in the stock market are actually doing pretty well. So there is a broad-based participation from most of the stocks in the stock market. So if you're not fully invested in the high-flying or what were the high-flying stocks or sectors, then you're probably still seeing positive returns despite the roller coaster that we're seeing in the overall market. But with this war resuming and it feels like we're heading into the midterm elections. We don't think that this war is, at this point, we're feeling pessimistic about the war as opposed to where we were 2 weeks ago. So we think that this is going to endure for a while, maybe even up to or past the midterm elections. We'll just see how it goes. But we did have Lindsey Graham pass away unexpectedly a week ago. Mitch McConnell has been missing in action, or at least unable to perform his duties. So we're expecting a lot of last-ditch efforts to push through some legislation before the midterms. So increased volatility as we're trying to see what's actually going to make it through and what Republicans are able to get passed. But the second quarter earnings have been good. The companies that have reported were sounding optimistic about the third quarter. Maybe that changes if we're back to full-blown war. We don't know for sure. So that's something that we'll be watching. Again, we don't think the Fed's going to increase interest rates at their meeting next week. If they do, obviously that's going to have some implications. So, a lot of things that we're paying attention to. If interest rates are potentially going higher, then that may give us an opportunity to do some rebalancing and add more interest rate products, either money markets or fixed income products, to try and capture some of those higher rates, because we don't think they're going to last forever. We do think that if we do see higher interest rates, it'll be a short-term phenomenon, and then by early next year or this time next year, we'll see lower interest rates. So that's something we could capitalize on if we think it's going to be a better opportunity than or lower the overall risk probability for the investments going forward. But that's kind of what we are looking at and thinking about and ready to share with you guys at this point. But if you have any other questions specifically about investments in your account, then please let us know. We're happy to take a look and share that with you. All right, as a final word, we came across this article in Bloomberg the other day about U.S. consumers losing $20 billion to online scams in 2025, as reported by the FBI. So our final word, I guess, is please be skeptical when you see email or text messages come through that don't look quite right. And please have a system in place where you can either contact the person that you think it's coming from or contact somebody else and get their opinion on whether or not we think it's legitimate. The major categories that we're seeing these scams come through, romance is a big one, invitations, employment, investments, and impersonation. Those are the five big categories that we're seeing these scams come through. In fact, so just the other day, we had arranged to do a family dinner at my parents' house, and the next day I got an email invitation from my mom that I thought was kind of weird that my mom would be sending out an invite for a family dinner that we had just arranged. But sometimes my mom likes to do e-cards for things, and so it felt kind of legitimate, but at the same time out of the ordinary. So I reached out to her and said, "Hey, are you spamming me? Is this legitimate?" And it came back that no, it was not legitimate. So don't click on anything, etc. And it had gone to everybody in her address book. So I was reaching out to my wife and my kids and just saying, "Hey, if you got this from grandma, please don't um don't click on it." But it's just kind of the world we live in. We'll have to keep changing passwords and being vigilant. But again, I think our big takeaway for the week is just please um, be skeptical and have a system in place where you can uh, try to prevent falling victim to any of these scams. We want to make sure that you keep as much money and we can invest it and grow it for your benefit, not for the benefit of any scammers. But if you have any questions or about getting a system in place, or if you want to copy this article, more information about the different categories, then we're happy to provide that. But otherwise, just hang in there and we'll see where things are in a couple weeks and we'll go from there.